What is going on? Welcome back to another episode of the Paper Gain Show. I'm Johnathan Rankin, joined by my co-host Matt Magee. Matt, how was your 4th of July weekend?
It was great. It was rainy here in Texas, but I know you were at Disney. How was yours?
It was fantastic. My daughter's turning 7 in a few weeks, so this was her birthday gift, and as we kind of talked about offline, based on the cost, she's not getting another gift till she's like 40. So it was a lot of fun, and I can't wait for you to go with your kids later, in a couple of years, because it's just something so you can't even describe it when you see the joy, on their face, and then it's hard to put a
That's
price tag on it until you check your bank statements. So
Yeah,
fun times, but we had bigger news over the 4th of July weekend with the passing of the one big beautiful bill, the new tax changes that are in play now. And so we're going to spend this episode breaking down all of the updates within that bill and how they impact you. So Matt, I want you to take away and let's break down this bill.
absolutely. First, I'll be looking at some notes over here to make sure we get the facts correct, given that there's a number of nuanced details here. And two, I'll throw myself under the bus. I'm pretty sure I predicted that this would not happen until like December at the last hour, like they typically do. But I just remembered I was obviously terribly wrong with that happening in early July. So it's nice to have something done. I guess um, the government spending and all of that was also part of this. They
Yeah.
obviously had to get this thing done before the end of the year, but
But also,
uh,
what better branding? I mean, it's so on brand for President Trump to be 4th of July passing the one big beautiful bill that's going to revolutionize and save America. I mean, there's nothing more on brand than that. So, it all makes sense to me.
yeah. I doubted him in the administration, but I was clearly proven wrong. So here's the format today. We're going to run through some of the impacts to individuals as well as like estate taxes, gifts, and then some as it relates to businesses and business owners, which are a lot of our clients. And so in its at its very core, this is a permanent extension of the original Tax Cuts and Jobs Act from 2017. So a lot of the individual as well as married filing jointly, married filing separately, all those the tax brackets, if you will, remain the same. And so wanted to start there. One of the big things that was in the kind of what he ran on, and then it was out of some of the proposed bills, was the Social Security being taxed. And it is still going to be taxed, but there is a senior deduction that has some phase in and phase out ranges depending on income. For married filing jointly, it's 150,000 to like 250,000. So if you make above 250, is my understanding, then you'll be phased out of that 6,000 per spouse. So 12,000 total. That is a deduction for years 2025 through 2028. So it's one of those that it will have to be reevaluated in a couple years if they can make it permanent. We'll see. But
Now, this was mainly, this was in lieu of the Social Security, because they didn't, obviously, as you mentioned, they didn't pass that. That wasn't included in this. But, is this President Trump's way of saying, hey, I didn't do this other thing, but I got you this over here? It kind of seems like
yeah,
it's the, okay. And then, I think there's a number of things as we've, talked about in preparing for this bill to pass before in a previous episode the, that are extensions that are going to go on until the next election cycle. So we can already
yeah,
predict what the commercials and and everything's going to run on, which is don't if you don't reelect us, then your taxes are going to go up because this deduction is going to go away. So just something to keep in mind in a couple of
Yeah,
years from now.
absolutely. We'll be on episode 4 or 500 at that point, but yeah, stay tuned. Uh, all right, so that's as it relates to Social Security. The child tax credit was made permanent, rises to 2,200 next year, and is indexed for inflation. Uh, the 750K mortgage interest capped, that's locked in, that has not been indexed for inflation. All right. The SALT tax, so state and local property taxes. This is a big one, that's lifted from 10,000 to 40,000 for
Wow.
the years 2025 through 2029, is my understanding, as long as your adjusted gross income is below 500K. And it's got a phase out pretty, I believe, 500K to 600K. So a pretty tight window there for married filing jointly.
Hmm.
But a big jump up from, I think last time we talked about it, at that point, it was proposed to be 30,000.
Yeah.
They always tweak the number as well as the number of tax years that so it's 40K for 2025 through 2029.
Gotcha. Okay. So staying under that $500,000 income limit, there's a lot of planning that you're going to want to do. If let's say you make above that, doing some strategic planning to get your income lower is going to be important,
Yeah,
right?
if you're able to. Obviously, if you're in that band of 5 to 600K,
Yeah.
especially like if you're uh, materially above that, then not as much you can do, depending on your circumstances. But that's where a good financial advisor as well as CPA can come in and evaluate what type of income, where that's coming,
Yeah.
and if you can get that adjusted gross income down to take advantage of that.
Yeah. Absolutely.
Um, let's see. So you can deduct up to 25K of tip income. I know that was one that made a lot of headlines. That's subject to some AGI phase outs. Um,
Yeah, and that one, it's interesting because when they initially put the bill together, it was, and the tips were based on being in a standard tip industry. So I haven't read all 800 pages of the bill or 800 plus pages, but I wonder if there's any clarification on job title because I remember
yeah,
initially it was extremely vague before.
yeah,
So if because anybody nowadays has the iPad that turns around and asks for a tip, and so
yeah, exactly.
what are they going to consider a standard tip profession is going to be interesting.
Yeah, I haven't seen the exact clarification, but I would be surprised if they didn't clarify the industries and specifics, and that AGI phase out might be lower than so that
So that
likely
yeah, what they
eliminates.
say is the tips have to be a normal part of the business.
Yeah,
And the IRS will publish a list of occupations where that's true within 90 days. So that's more to come, but I'm glad that they at least have some sort of definition for what that's going to be because I remember we talked about it before. That's a big gray area that's going to take a lot of there's going to be some manipulation there. You can easily see that. So.
yeah. Same for overtime pay as well. And that's for tax years 2025 through 2028. Deduct auto loan interest up to 10K on new US assembled cars 2025 through 2028. You're picking up on the themes here. Uh, a lot of these are changes on the margin, if you will, for the next 4 years. And so,
But if you think
uh,
of someone, if you do think of someone who is, let's say you're in a tip profession, or you have that as part of your income, and you use, let's say, I mean, I think of someone who is an Uber driver, or someone in
yeah,
that phase where, okay, tips are a part of your business. Now you can actually use those tips, get a deduction on those, and now you can buy a car that's built in the US, and now you get a deduction for that. So it just, there are some
yeah,
ways to really strategically use this to kind of take advantage of multiple different buckets here. And
oh,
so,
absolutely.
just something to think about. I know
Uh,
because I've got clients that have retired, and for fun, they will, they'll pick up some of these professions, and these are ways where you can, you know,
yeah,
people get out of the house and, hey, I can work 2 hours a week if I want to, but it's just something to, keep in mind.
yeah, that's very true. Estate tax. This is that exemption that was rumored to be cut in half. That is, if the Tax Cuts and Jobs Act had expired at the end of this year, which obviously did not happen. So it's going to be like 15 million in 2026, and so that continues to rise and be indexed for inflation. Um, it, you want to jump into the business stuff?
Yeah, let's jump in the business side because like you said, a lot of these things they're extensions, or they've got this window. But for the business side, there were some things that I think are important for business owners, and those who are listening that own a business or an entity that we've got to make sure we cover.
Yeah, 100% bonus depreciation for equipment that was made permanent. That's the big one for those real estate investors out there. Uh, there's some domestic R&D made cost made uh, fully expensable. That's made permanent. That's one I haven't seen a ton of use on for stuff like that. I highly recommend you getting in contact with your CPA, who will be a better person to talk to about that. Um, QBI, that's the section 199A, the pass through deduction of 20% that was made permanent with a wider phase in range. That's a big one.
But they did
Uh,
not change the professions. That was a big one. So
yeah,
professionals that are, CPAs, financial advisors, attorneys,
yeah,
doctors, unfortunately, we just don't qualify. So
that is correct. Um, One that is not on my list here, but the qualified small business stock that got expanded. That's one that, if done correctly, can be a huge tax windfall. The big thing there is you have to be a C corp, which I feel
mm,
like a lot of clients we work with, as well as just business owners here, they're just not C corps. That's something you just in general, much larger companies. But if you do some planning correctly, you can take advantage of that. So something to consider. But at least a lot of the clients that I see are S corps, or just they're just not C corps. What
yeah.
about you?
No, and that's something where, when you're getting into some of the nuances, whether it's something like that, or even the QBI, or, opportunity zones, and just some of these really nuanced things, even the bonus depreciation, and, the R&D expensing, those are things where you've got to make sure you've got a really good team around you, because,
Yeah,
some of these things I think of, opportunity zones, for example, a great way to defer any sort of capital gain, but there's so much nuance to it that you want to make sure that you're getting all of it right. I've got a client and close friend of mine who's considering going through either an opportunity zone fund, or building himself within inside of an opportunity zone to take advantage of it. but the legal costs and things just to make sure you stay compliant are extremely high. So it's just something to
Yeah.
keep in mind where, opportunity zones, they got, extended, that it's going to be a really good strategy for anything that has got a big capital gain in it that you
Yeah.
can defer, but it's just something where you want to make sure that you've got a really good team around you. That's the most important part.
Yeah, when you're diving into those more esoteric tax strategies, uh, having a very clear understanding of when that money goes in, when it can come out, what can come out, the tax consequences of it. Um, yeah, that's a good exercise and good reminder for everybody. There's a lot of some clean energy credits. We won't get into that. Um,
I did see I will say the HSA aspect. I did like that, because I think HSAs, so one of the things that, they now allow is that part-timers, can contribute to an HSA if you're, into Medicare, and HSA catch-ups are allowed for either spouse to add more to an account. So HSAs to me are one of the most underutilized accounts in retirement planning just because of that qualification of needing to be on that high deductible plan. But, if you can if you can allow yourself, if your family can be on that high deductible plan, it's one of the most powerful accounts out there. So I was glad to see that there were some, additions to that, that strategy.
yeah, while we're talking in your notes, like I know 529s, the contribution limits were expanded. Do you have that one readily available? That's one I don't have the specifics on, but would love to hit on.
Yeah, give me 1 second. Um, I'll dig for that. But while I'm going, because there's so much to go through on here.
Yeah.
What if you're listening to this and you see that this bill's passed and you're just wondering, okay, what do I do now? What are some of the planning things that someone can start implementing or thinking about right now that might make tax time more efficient come the end of the year? Because the last thing you want to do is be scrambling towards year end to try to squeeze some things in.
Yeah, if I um, uh, say it's easier when you put like concrete examples around this. I feel like if you're somebody that's uh, got a couple kids, you're working, you're a small business owner, might have one spouse that's a W 2 income, you're a high earner, but you're not at the call it the 37% tax bracket. Um, I think sitting down proactively with your CPA, if you don't have a good CPA, I highly recommend getting one now and having those conversations before the end of the year, ideally with a couple months left to take advantage and implement any changes. If you don't have an advisor that's helping with planning and you're at that point where it could make sense. Highly recommend that. And just looking as we went through these are all over the spectrum, depending on your specific situation. So you could have somebody making 500,000 that's all W two income that can't do very much, or
Yeah.
you could have somebody making 500,000 that's a small business owner, or at least some of that half that income is from a small business that you're able to take advantage of a ton of these things and really get that SALT deduction and QBI and prepare your business for a future sale. And so it really just depends on your situation. So lots of gray areas here, but highly recommend being proactive and starting to have those conversations if you're not already. What about you?
Absolutely. Those are I think, I mean, you covered quite a bit. I did find the 529 thing, so I did want to kind of go back to that. So what the big beautiful bill did is it increased the withdrawal limits for 529. So
Okay.
um, before, families can withdraw up to $10,000 a year for elementary or secondary education, but
Yeah.
then the new bill expands that to $20,000 per year, which I
Okay.
think is in line with more, if you have a large 529 plan that, let's say a family gifted or grandparents, you want to use that for private tuition before college, it's there to help out, which, yeah, I would say I don't know many people that use it for private school, because a lot of it is just used for
I
college, but
see.
that's there,
Yeah.
and it's a good reminder to know that it's there. So,
Yeah.
um,
I've done it for one person, and
yeah,
it worked very well, even though like they they more than had the income to meet that obligation, but the the 529s got super funded. They were at a point where it was just to make sure that those didn't get out of hand, and just one of those options that take advantage of it while you can. And uh, they definitely did not do it when the kids were super young, but one of those things, once they kind of started doing it every summer, you would kick out that 10,000. So
yeah.
for people like that,
I
have
think
had
if you're
a
able to
base.
get if you're able to get a 529 plan super funded when the child's one, two, extremely young, then yeah, I think that will make sense. It's just, I would imagine that most people aren't super funding it, and they're doing it
Yeah,
through ongoing contributions. And you know I don't I don't know, to if you want to save 15,000 a year, but then take out 10, or if you were taking out 10 just to pay for private school, I
yeah,
don't know how many people were doing that, just with your,
yeah.
putting the money at risk. So, just something to think about. But there is, like you said, there's a lot in this bill. A lot of it from a planning side of things is individualized. But I think the big breath that everybody can kind of gasp out is that we don't have to deal with any tax increases right now for most people.
Yeah.
So that's the positive. But really, it's trying to figure out how you can fit your situation into some of these nuances that can help reduce
Mhm.
your taxes. That's the planning side of it that's going to be important, especially with the business side, the opportunity zone funds. Those are the things that I think you could be really strategic on, and start reducing taxes.
Absolutely. And we'll include some additional resources in the video show notes, if you will. But because I know we missed plenty of things, but hit on the the big ticket items, if you will, that affect individuals, couples, as well as business owners.
Yeah.
And so we'll continue. We love talking about taxes and financial planning. So I'm sure we'll continue hitting on these topics as everybody digests this and learns more and starts to implement and different things. But wanted to
Mhm.
give at least some form of an overview and get that out in a timely manner.
Yeah, and now's a great time to have conversations with your CPA, just because we're in between tax seasons. If you filed an extension, they still have a little bit of time, and we're past the April deadline. So, now's probably a pretty good time to have some of those conversations. So, Matt, this was really good breaking this down. And if you are listening to this, make sure you hit that subscribe button, follow us along. We'll be back here next week, and Matt, we'll be talking soon. All right,
All right, sounds
see
good.
you
See
then.
you soon.
Oh.